everyone. Welcome to another episode of In Conversation by Advisor Coach. Today, in conversation, once again, our guest is Mr. Pratik Oswal, Chief of Passive Business with Motilal Oswal Mutual Fund. Welcome, Pratik, to In Conversation with Advisor Coach today.
Thanks for having me. Looking
It's
forward to
always good. It's always good to have you back. There's so much to learn. The amount of passive funds which you know uh, Motilal Oswal mutual fund has been launching and the thought and the ideas. It's very, very interesting to have you and learn from you about the various aspects of passive investing. And now today as you talk about the factor investing. So tell me, before we get into the new fund offer which you've launched, what is factor investing all about, and how is it different between an active and a passive fund? Where does it fit in?
Yeah. Factor investing is also called as smart beta investing.
Hmm.
Smart beta factors the same thing. They're interchangeable, but basically, factor investing falls in between active and passive investing. There are two styles which are very common: active and passive. Active is where you have a fund manager who takes a call about which stock to buy, which stock to sell. Passive is where you don't have any fund manager. Your money is basically tracking the index, and the returns you're going to get is the same as the index or a little bit lower. That's factor investing actually is interesting because it has the benefits of both active and passive investing built into one. In active investing, the idea is that the fund manager's job is to deliver alpha.
Hmm.
Factor funds deliver alpha. So we've seen in India that almost all factor funds in India the last 10 to 15 years time have delivered alpha,
Hmm.
but it has the construct of a passive fund. So it's low cost, it's transparent, it's rules based. So actually it's an index fund that gives you alpha. So it has the best of both worlds where it has the cost, transparency, and the rules based framework of index funds with the outperformance of active funds. So that's what factor investing is. Within factor investing, there are multiple styles. The
Hmm.
way I would like to talk about factors is basically strategies that determine a stock's long term return and risk characteristics. So, for example, a fund manager, a lot of fund managers have a value style or a growth style or a quality style or so these are essentially can be also called the style-based investing can also be
Hmm.
called
Hmm.
as factor-based. So you can
Hmm.
actually extract this style and systematically create a fund around that style. So
Hmm.
today
Hmm.
within factor funds, you have something called value fund,
Hmm.
value index fund,
Hmm.
which essentially means that you're buying stocks that are cheap. There is something called quality fund. What quality index means that you're essentially buying stocks that have high quality. And this is not subjective, this is objective quality. So quality will mean companies with high profitability, high return ratios, low debt, you
Hmm.
know. So those are quality. You have something called low vol index fund, which is also a factor. We are essentially playing the non-cyclical stocks that have very high price stability. And you also have the last factor, which is momentum, which is the most
Hmm.
popular factor in India, which really works well in bull markets, where
Hmm.
you're essentially buying stocks that are in momentum,
Hmm.
and that does extremely well. So this is the four most popular factors. There are many other factors, but these four are
Hmm.
very popular. So all four fall under factor investing. All four have demonstrated outperformance over a Nifty 50 or a Nifty 500. But they also have the pitfalls of active investing, which is that
Hmm.
these factors are cyclical. So
Hmm.
it's not like a strategy is always outperforming all the time. There are periods of outperformance and underperformance. So
Hmm.
investors are looking at factor investing should essentially expect cyclicality in returns and also hold on it for say minimum 5 years to really see good outcomes.
Sure. Tell me, so factor investing is extremely popular in the Western part of the world, right?
Yes.
In the developed
Yeah.
market.
So actually, in India, the largest
Hmm.
category is active funds, followed by passive funds, followed by factor funds.
Hmm.
The US, the largest category is your index funds, S&P,
Hmm.
NASDAQ, followed by factor funds, followed by
Yes.
active funds.
And why is like that? Why is like that?
Because I think passive as a category is quite large in the
Yeah.
US. So approximately 55 to 60% of the mutual fund industry
Hmm.
is passive,
Hmm. Hmm.
index funds and ETFs. So essentially, they are already a big part of the industry.
Hmm.
So which is why I think, factors would be, say, approximately, maybe one third of that. So that's why factor investing is quite large. Also, I think there is the factors have also demonstrated outperformance in the US as well. So
Hmm.
people have seen that you can get the benefits of active and passive investing in a single fund. So
Hmm.
that's why it's become quite large as a category in the US. In India, I think it's still very small, but people are. I'm surprised by the growth in factor investing.
Hmm.
So
Hmm.
we launched 8 factor funds in 2021,
Hmm.
about 5 years back, and back then the category was about 1,000 crore in AUM.
Hmm.
Today the category is 50,000 crore. So
50,000
yeah, so
in
50x
India.
growth in India. Yeah, yeah. So
Wow.
50x growth in the last 5 years, 4 to 5 years time, which I think is pretty good. And I wouldn't be surprised if this goes to 3, 4, 5 lakh crores over the next, say, 5 to 7 years time. So
Wow.
I think there's a lot of factor based. Now you have factor active funds also that
Hmm.
AMCs are launching.
Hmm.
So there's a lot of traction happening in this space.
Sure, absolutely. I think somewhere the reason is also that the price discovery of the stocks, in a mature developed markets like the US is largely done, correct? And so obviously then you run the funds more on algos and these factors, etc. And markets like India, the price discoveries, the price mismatches, are still being are still aligning.
Yeah.
That kind of gives a space for active and of course factors like you said 50,000 crore, that's a huge, huge size. That's a huge size. Absolutely. So, Motilal Oswal have launched their multi-factor passive fund of funds, NFO, on the 20th February, and closing on 6th of March. Now, exactly, they're using the same four factors which you mentioned. The low volatility, the growth, the quality, and the momentum. Now, obviously, they're quite distinct in their own behavior and characteristics, right? Now, how do you bind them together in this fund? Correct? Because momentum is very different than a value, or a quality, etc. So how do you bring all these four together and chain them together to operate in this factor investing fund? And I believe 25% is the weightage which has been assigned for each of these factors. Why so? What did your back testing results did show you that yeah, 25% is a good weight to have?
Yeah, so the objective, the first let's talk about the pain point. A lot of
Hmm.
investors who invest in factor funds, there are 4 or 5 different options. There's momentum, there's alpha, there's quality, there's value, there's low vol. There are many factors out there, and we believe that um, the decision making factor is quite tough. Investors they'll keep asking me which factor should I invest in.
Hmm. Hmm.
Now, the problem is which factor is that, obviously any factor is good.
Hmm.
You can choose momentum, but you
Hmm.
have to expect, I would say, some sort of cyclicality in the return stream. So the problem is one is there's a choice paralysis where investors don't know what to invest in. And second is that investors also are wary of underperformance in factors in the short term.
Hmm.
So the idea behind this fund was to create a fund which over the long term delivers the same outperformance
Hmm. Hmm. Hmm.
as what you would get in a factor based investing framework without the cyclicality of the return stream. So the idea is that can we remove underperformance or can we minimize underperformance while giving you a similar upside?
Hmm.
And that was and also remove decision making bias.
Sure,
Which
sure.
factor should I invest in? When should I? So I think it's a phenomenal fund that does all three. It removes decision making fatigue. It gives you the outperformance and also lowers the unpredictability of factors in terms of
Yeah,
the performance.
yeah.
So that's the solution that we've come across, and we've also believed that we want to not take an active call on factors.
Hmm.
There's two ways in which you can play factors. One is to have an equal weight where you're assigning 25%, which I'll be honest, people might say it's too simple. But I think simplicity is its strength.
Hmm.
Because the moment I make an active call and I go wrong, I have to answer to investors.
Hmm. Hmm.
And the probability of being wrong is also there.
Hmm.
You might say invest 50% in momentum, but the momentum might not do well, or
Hmm.
50% in something else. So the idea here is to keep something which is very simple, systematic, something that you can invest in for 10,
Hmm.
50, 20 years.
Yeah.
So there is no factor timing. There is no, the backtest shows very low underperformance. The backtest shows that the outperformance is also quite strong. Costs also low. It's very transparent. So that was the idea behind this fund. So what we've done is we've essentially taken 4 of our ETFs, the momentum, low vol, quality, value. These are the
Hmm.
4 most popular factors, and put 25% in each bucket. And we'll only rebalance it if the weightages deviate by more than 5%. So
Okay.
if momentum goes to 30% plus or below 20%, only then will we rebalance the
So
portfolio.
it's an immediate interjection of rebalancing, or you still wait for a quarter or a
We
month?
wait for the quarter. So end
Gotcha.
of quarter, we would do the analysis. And if the
Sure.
weightages move by 5% or more, then we would rebalance it to
Plus
make it
minus 5%.
systematic.
Sure.
So it's
Okay.
very simple.
Hmm.
In the last 20 years, it's only been rebalanced about 14 times.
Hmm. Hmm.
So one more benefit of this is that it's very low churn. So low taxes, low transaction cost. So low transaction cost, low taxes, high returns, not much underperformance. So
Hmm.
that's the idea behind this fund, and also super simple to for investors to understand. So we believe that this is a very good and it has a good mix of all four
Hmm.
factors. So
Right.
you are also getting good diversification in your return stream,
Hmm.
so which I think is an important point for your future returns.
Hmm.
So this model we backtested and it's given an outperformance of close to 5 to 6% over
Hmm.
20 years. While the underperformance is fairly, they're very small, points in time when they're underperformance. So, essentially something which should be able to outperform. And guess what? Even the drawdowns are lower than Nifty 50 or Nifty 500.
Really?
Yeah.
Low
So,
drawdowns.
so this
Okay.
will actually fall less in a bear
Huh.
market,
Huh.
and it will actually go higher in a bull market. So essentially, you're getting something which works across market conditions. The
Sure.
problem with factor investing is that the reason why factors are unpredictable is because the markets are unpredictable.
Hmm. Hmm.
If you could
Hmm.
predict that the next year is a bull market, you just buy momentum and let it go.
Hmm.
If you could predict that next year is a bear market, you can just buy a low wall and that's it. The
Hmm.
problem is these factors work very consistently across market conditions. So in a bull
Sure.
market, momentum does very well. In a bear market, low wall quality does well. In a recovery market, value does very well.
Hmm.
But because you can't predict these things, you can't figure out which factor to buy. This fund, you don't. It works at least historically in bull, bear, and recovery markets. So you don't have to be worried about ever making a wrong decision. So that's and that's the sort of benefit of this sort of a fund. So I think it's a great solution.
Hmm.
It really eases investor fatigue. And
Hmm.
the last thing is that a lot of investors tend to buy multiple factors.
Hmm.
They tend to buy, say, 50% low wall, 50% momentum, which is a good strategy. The problem is, you'll at any point in time, you'll have one which will do well and one which will not, you know,
Hmm.
because they're two separate funds. Not many people see the combination returns, they see it
Hmm. Hmm.
separately.
Hmm. Hmm.
So
Hmm.
this fund is like single NAV.
Hmm.
So you don't have to worry about underperformance of one or two funds, about feeling
Absolutely.
bad
Yeah.
about something doing
Yeah.
badly. So I think it's that's also an added benefit when people are investing in this fund.
And I think that's where it's very important for all these factors to play out. You need, at least a longish period, upwards of 5 to 7 years, so that you see more of these cycles coming in, low wall or momentum or quality or growth, etc. Right? Because in a short span, what could happen is that one factor might eat into the return of the other factor, as it does very, very well, or the other one underperforms. So when you get into a long-term space, let's say 5, 10 years, then that's a time when you'll actually get to see the real, machinery actually playing out in your favor.
Yeah, exactly. So I think yeah, you said right. So I think over a long-term period, investors should expect, say, 2 to 3% sort of an outperformance
Hmm.
over, over benchmarks, broad-based benchmarks. Historically, it's been a lot higher, but we think that the market has become a lot more efficient than it has been. Factor investing was unheard of 20 years back.
Hmm.
So almost nobody would have invested in factor investing.
Hmm.
So it
Hmm.
was fairly inefficient and you could make lots of money. Today, a lot of people know about it. So I think
Yeah,
the ability to outperform is obviously a lot less than what it was 20 years back. So investors should keep that in mind. You should not expect 5%, 6% outperformance. I think 2% is a good expectation to have over the long term.
sure, sure, sure. Sure. So tell me something in terms of, is there any global example of a similar strategy being run, in the developed markets?
Yeah, so you have single factor strategies and
Huh.
you have multiple factor strategy.
Yeah.
So multi-factor strategy is where you have multiple factors in a single fund. In India, also you have a lot of quant funds that
Hmm.
have that employ that deploy in multiple factors. We have multiple quant funds where use factors.
Hmm.
So I think there are multiple funds out there that are looking at deploying in multi-factor funds, single factor funds.
Hmm.
So there are many examples of this, globally in the US or in Europe where investors don't want to take single factor exposure. They want to
Hmm.
take a nice, diversified, simple approach towards, just accessing factor investing.
Hmm.
This fund does very well in that.
Excellent, excellent, excellent. So obviously the underlying is your other
ETFs.
ETFs, right? So
Yes.
what kind of overall stock exposure an investor gets through that one NEV?
So stock exposure would be about between 100 to 120 stocks would be the exposure. Top 10 stocks would be about 24-25% of the portfolio. So fairly diversified,
Very diversified.
primarily a large to mid cap index. About 80 to 90% of the exposure should be in large and mid caps. About 60 to 70% will be in large caps. So, I mean, you can imagine such a high outperformance while having a large cap is sort of
That's
a
right.
fund.
Mm-hmm.
So I think that's also an added benefit with this sort of a fund where it is a relatively safe, large and mid cap sort of a fund. As
Mm-hmm.
of now, it's about a 5% exposure to small caps. It
Mm-hmm.
might go up to say 10 or 15 maximum. So I think that's the beauty of this sort of a fund.
Sure, sure. So tell me, Pratik, Motilal Oswal has been launching, a lot of these passive funds, factor funds, index funds, etc. And so, what's the way ahead, and what's the thought process? Because we're seeing a number of such interesting funds coming from your house.
Yeah, so we'll continue to be launching these interesting funds. I think we believe that we are catering to a very large set of investors, and a large set of investors have different needs.
Hmm.
So we believe that not all funds are meant for all investors. Investors invest as per their risk appetite and as per their preferences.
Sure.
So, we have 65 funds today, and
Hmm.
all of them get daily inflows. So that,
65.
yeah, yeah, all of them get
I
daily
think must
inflows.
be the largest bouquet.
I would say that, yes.
Yeah.
Yeah, combined. Yeah, yeah. Yeah.
Yeah.
And we wanted to be 80, but we
Uh,
haven't got approvals in time this year.
right.
Hopefully we can cover up. But the idea is that, there are large investors,
Hmm.
many types of investors we're catering to. So we would like to say that we only talk about the funds that we think are very retail centric. Like this multi-factor fund of fund is something which I think everyone should look at. It's a phenomenal fund.
Hmm.
So I think there are only very few funds, maybe out of 65, 4 or 5 that we really talk about in public.
Hmm.
The
Hmm.
rest is there. There are investors who want it, they can buy it.
Tell me something. Interesting point you mentioned is that the retail investor. So, how have you seen the retail investor warming up, to these passive funds and factor investing? Because when you say 65 funds, and let's say the assets under management are X through those funds, right? So, how do you see the retail investors warming up? Are they actually, coming into these passive strategies of recently? That's the what you've seen.
Yeah, so 80% of our UM is retail, 70 to 80% of our, so it's mostly
Oh,
retail
that's to my
participation. I think,
surprise, 70 to 80%.
yeah, yeah, yeah.
Oh, that's a big number. Okay.
The institutions tend to stick to Nifty 50,
Hmm.
Sensex,
Hmm.
and maybe a IT or a bank index. These four are where there is heavy institutional participation. But the rest of the funds are fairly retail centric. So I would say we have about a million and a half customers, I 20 to 25 lakh customers who are invested in passive funds, which I think is a very good number.
It's a good number.
Yeah, yeah. And more than index funds, what surprised us was the volumes that we are getting in ETFs.
Hmm.
So ETFs are now almost like stocks.
Hmm. Hmm.
So they are like ideas that you can trade on, you can invest in, you can buy, sell. So we believe that there's a lot of trading activity happening in ETFs, a lot of investing happening in index funds. SIP, we have a pretty large SIP book also.
Hmm.
Overall, retail investors have adopted passive funds in a very big way. Unlike most AMCs that are concentrated in one, two passive funds, we have about 10 passive funds that are 1,000 crore plus. So we are getting broad-based acceptance for a lot of our index funds, and I think we're seeing money across broad-based funds, thematic funds, sector funds. Gold and silver obviously has been a
Hmm.
crazy
Hmm. Hmm.
thing for us. We have a very nice gold and silver fund,
Yes.
which is now one of the largest funds in the industry.
Hmm.
So I think there also we're seeing incredible traction.
Yes.
So the idea is that we need to manufacture products where we see wealth creation.
Hmm.
So if you see most of our funds, our equity funds, almost all of them have beaten the Nifty 50.
Hmm.
So there is wealth creation happening in almost all of them. But obviously, people have different objectives, different preferences, different needs. So we have to cater to all of them, and that will lead to us launching a lot more passive funds in the future.
Excellent, excellent. So a lot of exciting times ahead.
Yeah, yeah, yeah.
Great,
Yeah.
great. So, well, for our viewers, this is Mr. Pratik Oswal, Chief of Passive Business with Motilal Oswal Mutual Fund, talking about their latest fund offering, Motilal Oswal Multi-Factor Passive Fund of Funds. The NFO launched on 20th of February and closing on 6th of March. And I completely agree with Pratik that factor investing, passive investments, ETFs, I think the way they have shaped up in the past about 5 years, nobody beyond their imagination could have thought that they would explode so much. And that's where a lot of favor is finding, because every investor is finding that, okay, a part of my portfolio allocation must go into such kind of strategies. So, well, Pratik, thank you very much. Always a pleasure. A lot to learn from you in terms of the passive investing. Thank you so much for taking us through your new fund offer, and all the very best for it.
Thank you so much. Thank you so much.
Our pleasure, our pleasure. And for our viewers, please press that subscription button and subscribe to the Advisor Coach YouTube channel for more such interesting updates. Thank you, Pradeep, for joining me today.
Thank you so much. Thank you so
Thank
much.
you.